All right, everybody. So we're going to get started. And I got you all here. I know how many people are banging on the door just to get in this room, get on this video. We're going to talk about taxes. We're going to talk about taxes and real estate. Now, if you haven't already seen, I'm going to put a little finger up here for when I throw this on YouTube. Allison McLeod and I, she's an accountant that I just adore. We did a whole video on taxes. We did it specifically on real estate and then how realtors can interact with taxes. And she also gave some really good advice about how to set up your business for taxes, whether you need it to be in an LLC or a PA or whatever it may be. And she basically said, walk before you run, which I thought was fantastic. See if you can actually make a living doing this before worrying about the tax side of it. And so we're going to use that as the same issue for selling real estate. See if you can make an income off of it before worrying about things like a 1031. This is only for if you have a profit to worry about. Now, before we jump into that, Dad, I also want to do a little tickler.
Mm.
We had 6 questions that Mike Hughes asked you this morning, and I thought they were really good. And I thought it was probably worth repeating for those who didn't get to see his video on it this morning.
Mm.
So, Dad, let me ask you a couple of questions. Number one, and I want the quick answer. Which sales contract do you recommend for a buyer?
As is.
As is, as is. Now, does that mean that a buyer can't ask for repairs?
Absolutely not.
Yeah, so I've recently heard multiple buyers who refuse to use an as-is contract. Is that, do they not understand what we're talking
I
about?
don't think they're explained right. I think the title of the contract is terrible.
Yeah,
It's not
yeah,
clear what the hell the thing is.
right.
It couldn't be more pro buyer. It
I
really.
think that's the key. The as-is contract could not be more buyer because they have the ability to get out for any reason. They have the ability to renegotiate, to ask for repairs, ask for credit, ask for extensions. It could not be more buyer-centric, which leads to the second question. What if you're representing a seller? What do you think on the favorite contract for a seller? And then separately, what's your least favorite contract for a seller?
My personal, not one that I would recommend for the realtors to use, I would use the standard NABOR with a big fat deposit up front. So I'm in
Okay.
control on whether or not I do certain repairs or not.
Yeah. Yeah.
So I like to be in charge, but it's
Yeah,
hard to
so
find.
I think that makes a lot of sense. It's personally not my favorite, but I could totally understand why a seller would prefer a neighbor standard contract over an as-is contract because it limits the number of reasons a buyer could terminate and get their money back. And you
Right.
mentioned, Dad, a big first deposit. Why does that matter?
Because the remedy in NABOR is limited to deposits made. So, as we talked about earlier, $1,000 deposit or a deposit 3 days after the effective date doesn't mean a darn thing. It's
Right,
usually,
exactly. So I see why, if you have $100,000 deposit down and someone wants to argue with you over whether a dishwasher is worth $200 or $400,
right.
you have a lot more leverage as a seller because they're
Yeah.
not going to risk 100 grand to make an extra 200 bucks. They're just not going
It'd
to do that.
be a risk reward analysis, it'd be crazy.
So the question Mike didn't ask you was, what's your least favorite? And think about this one, your least favorite seller contract.
Probably the standard FAR bar.
Isn't that interesting? I thought you would say that, and I agree with you.
It's so complex. I mean, if it takes somebody with my education level or your education level to figure the darn thing out, it's kind of scary, the trouble. Just the financing clause. You look at the financing clause on what happens if you do nothing by the loan approval date and how many realtors are relatively new.
Yeah,
You look at the neighbor numbers on new, realtors. It's frightening.
yeah.
They have to understand this complex legal document.
Well, and even if we just stick to the inspection language, it obligates the seller to do repairs, which if you haven't explained that to your seller, you're in probably some, you're not looking so good in front of that
Yeah,
client.
they got those three categories, and two of the three, the seller can agree to pay the overage, and one of them they cannot. And you got to know all that
Yeah.
crap. Are
So I
my
think I think that's the TikTok worthy clip right there. Your favorite contract is the NABOR standard, and your least favorite is the FAR standard. And somewhere in the middle are the as-is contracts, especially for a seller. Next question, high-end listing, and I'll answer this one. If you have a ultra high, if you have an ultra high-end listing, say something over $10 million, it doesn't make sense to have the commission come directly from the seller rather than from the listing company. And why? Now, the reason why this question came up is because we've kind of made the decision that we want to limit risk. Just generally, as a population, we want to limit our risk.
right?
So with these super high-end commissions, the risk that brokers have is that you'll mess up the form. You might mess up your listing agreement, or you mess up the broker to broker compensation
Mm,
agreement, or whatever it may be. So in that case, what a lot of brokers are wanting to do is say, all right, we're not going to pay the buyer side commission. We're going to let the seller pay that directly. So if we use, let's say normally it's going to be a 4% total commission, half of it payable to the buyer's agent. Well, in this case, we're only going to negotiate 2% on our listing agreement. And
right.
then when the buyer makes an offer, they can ask for their extra 2% directly from the seller. And that's really to limit risk. And you could apply this across the board. You could apply this on any contract. Doesn't matter the size of the deal, but specifically on those big deals, we're wanting to kind of simplify and have the seller agree to pay the buyer broker directly. So that's kind of where that comes
What
into
if
play.
you're on both sides in that, Christian? Do you still do the buyer broker at 0%?
Yes, you still do the buyer broker at 0%. I actually have an email going out this weekend. I've already written it, talking about what you should do in those scenarios, and double check, look at the NAR FAQs of what it means to be working with a buyer.
Yeah, giving guidance to the buyer, and
Giving guidance.
they're gonna think
Here's
you're
how I'll just give a quick sneak peek on that. You're the listing agent, a buyer reaches out to you directly. Do you need a buyer broker agreement to show the house? No, you do
no.
not. But once you're there and the buyer says, hey, this house is great, we'd love to make an offer. Can you write the offer for us? Can you help us? That's when you are working with a buyer, at least in our legal expertise. That's what we believe. And so at that point, we would recommend definitely get a BBA. And depending on how your listing agreement is written, you might be able to put, zero, or you put the actual amount that the buyer will be paying you.
I worry about
If
the he said, she said arguments, Christian. I get a buyer broker no matter what, because they're going to say, you gave them guidance, even if you didn't, if they're looking
Yeah,
for a way out and somebody to blame.
yeah,
So, just to cover your rear end so you don't get into the he said, she said situations.
I agree. I
I not,
agree. This is the next question. If an appliance breaks after the property is under contract, let's say, and I'm going to add a little bit to this question, what if it's after inspections as well? So I had this come up where the inspection went great, pool equipment was fine, and then it broke. And the seller called me in a panic. Do I really have to fix this? Yes.
yes.
Seller has to fix that maintenance obligation on the seller, anything prior to closing. Dad, you had a scenario when my sister was buying a house, air conditioning broke the day before closing, and the seller and buyer just kind of figured out a good solution. They replaced the air conditioner, the seller paid half, and I think my sister paid half. So that was just good communication. The seller knew they were on the hook for getting it up and running, but didn't want to throw money at a problem. So I thought that was good. If you have a special assessment that is levied after the property is under contract, but before closing, who pays it? Dad, you mentioned Section 6. It kind of matters on what kind of assessment or how it's paid. Is it paid in installments? Is it paid? But they've changed this section recently. So definitely pay attention. Line 93 seems to be tripping a lot of people up with installment payments.
I went to a seminar at NABOR that discussed the NABOR contract, and the speaker specifically went over this paragraph 6 and compared it to what is a pending lien under FARBAR versus a pending lien under NABOR. Now, NABOR, they don't have any parameters. So if it's anything significant, that you heard a rumor that there's going to be a special assessment, you don't have the three requirements of a special assessment in place quite yet. It's really prudent to put it in writing that you heard this rumor and this is what it is, and you should check it out so they don't get caught by the back end of that paragraph 6.
Yeah, I think it really depends on what's fair and what the contract says. And over disclose. When we were selling houses at the end of last year or
Right.
condos, there were all these special assessments coming in faster than we could even predict. And a lot of our sellers were kind of absentee owners. They weren't really paying attention to the meeting minutes and they really didn't know. So when an assessment would come up, it seemed like it was coming up out of the blue. And Section 6 was really important to teach
Mm.
us, all right, here's what is contractually the buyer's responsibility, and then here's where it's not. So ultimately, it's on the buyer unless it goes over a certain amount. And it also has to be passed. They have to actually pass it. So if for any of that to come into play, but it's tricky. I would say pay special close attention to line 93 where you check who's responsible. I had a deal almost fall apart because there was an installment assessment and the seller was checked and the listing broker didn't even
Yeah.
notice. And
I'm,
that was a $9,000 cost to the seller.
I'm saying
And
look at line 96, Christian. It talks about pending liens, and what is a pending lien is not defined like it is in FARBAR. So that
yeah,
last sentence in 6 could cover a situation where, 6 months after the closing, there's a special assessment to fund reserves because of
yeah.
milestone analysis. Um, and you had an email, or you had some inkling that this was coming up, and it wasn't something where you knew the identity of the lienor and you didn't know the amount and all that jazz.
Right.
So it's not doesn't comply with its definition of an existing special assessment, but it might be a pending one, sort of like FARBAR, but it's much broader.
Much broader. Yeah. It would be worth spending some time on Section 6 if you want to review
Yeah,
that
and
again.
that was a recent NABOR seminar. I mean, that was probably
Yeah.
2, 3 weeks ago. I went to that one.
Yeah, I'm saying that all the realtors should be looking at Section 6 because it's really more and more becoming a relevant section that we need to pay close attention
Yeah.
to. The last question on there was about being turnkey. Mike Hughes and I did a video last week, or maybe it was 2 weeks ago,
Mm-hmm.
about language written into a contract. And one of the items I talked about was just being lazy about defining what's transferring with the property.
Right.
Perfect world, you do an inventory list. You just do. And the listing agents really need to take that onus when they first get the listing. You've got weeks and weeks, maybe not, maybe it's days, but you've got time to put together a listing or an inventory list. That's the most beneficial thing. And then separately, I always recommend that the sellers remove property from the house that they're not selling. That's not going with the property. So if you're keeping it, I don't care how nice it looks. If you're trying to sell furniture, but there's one piece you want to keep, you need to take it with you, or you need to be very specific about it being an exclusion. So,
Even if it's a fixture, because the regular human being doesn't know the difference between fixtures and non-fixtures. And you look at Mike's question, a chandelier, it's attached,
yeah,
and the
yeah,
fixtures are hanging on a hook. Now, I've had a whole bunch where there's a
yeah.
mirror hanging on a hook in a bathroom and somebody takes it. It's
I
not,
had that too. I had a deal, and I was telling a client about it yesterday, where they removed a mirror from the bathroom. And, if you remove a mirror from the master bedroom,
Hmm,
you probably could get away with that. But if you remove the only mirror from a bathroom, you walk in, there's a sink and no
hmm.
mirror. They notice, the buyers notice. And they did in this case. The buyer was really upset. They felt like they had been misled or defrauded, and they made the seller bring it back.
Did I ever tell you the story about the buyer or the seller who removed the pillars from the front of the house, off the house? And this was in Port Royal.
No,
Did I tell you this one?
no.
The listing agent was, and I'm just going to name names because she's not living anymore, Ruth Tredis. Her husband was a retired, it's actually a sitting judge at the time. Uh, and the buyers, it was her listing. Our buyer, my buyer, was a Boston litigator. And he found out they removed the pillars from the front of the house, some fixtures inside the house, and they even dug up plants from the yard. And they were threatening Ruth, Judge Tredis's wife, and she had a heart condition. So he calls me at home, had my home number, and told me that if something happens to Ruth, he's going to hunt this guy down and shoot him. So I had to call my buyer and say, he means it. This guy's the real deal. And we got it all resolved because another attorney I knew was on the other side. But, to get a judge calling you at home at night, threatening to shoot somebody.
I wish the seller of my house had kept the columns. That would have been great. He can take them. They're a little much. All right, so those are 6 questions that I thought were really good and timely. And so I appreciate Mike for putting that list together. But I was hoping now we'll get into the real topic. Actually, Christina had a quick question. If the seller's leaving the country and you represent the buyer, is there any way to keep money after closing for X number of days to make sure items won't break down? Recently, 2 new pool pumps died in 2 weeks after closing, and pool company stated to the new owners that the buyer bought from Alibaba demanded pumps be installed, knowing they would be broken down. So, Christina, I think I know what you're asking. Um, it's actually what you're suggesting would be a very unusual situation. You're basically saying that because the seller is going out of town, they're not going to be available. They're moving out of country. You'll never see them again. That you're trying to protect against potential fraud, I assume. Because under normal circumstances, if a buyer buys the house, they're on the hook. If the pool pumps break 2 months later, 2 weeks later, 2 hours later, the buyer is on the hook. And I've had that before where the air conditioning broke the day of closing, but after closing. And the buyer called and said, "What do I do?" And I said, "Why are you calling your lawyer? You need to call an HVAC company. Go get fixed." I think that's the key. But what Christina's suggesting is now you have a seller that we don't trust, that maybe there's some sort of fraud involved or we're worried about it. And we're asking, right, hold money for 30 days in an escrow account if something were to break that wasn't disclosed. Yes, you could do it, Christina. I don't know if you'd actually accomplish getting that done. I think that would be a very, very hard deal to negotiate, and the seller might just take someone else's offer. Pretty
You might
unusual.
put your deposit at risk too. I don't think I'd touch that at all, honestly.
I think you just tell the buyer, look, we're just not going to be able to protect against that. Do your inspection, double check it, get your inspector to come back at the walkthrough inspection. And if for some reason the seller is misleading us, then there's not much we can do in that case. You're kind of in a little bit of hot water no matter what. All right, so 1031. 1031. It took me a minute to get there. We're 21 minutes in. We're going to talk about 1031s. Okay, so 1031 is a tax code that basically says you can sell an investment property, and as long as you buy a replacement, a like kind replacement, you don't have to pay taxes on the sale. Let's give some hypotheticals, Dad. So you buy a rental property for $200,000, you hold it for a couple of years, you depreciate it, and then you sell it for $300,000. So on paper, you've got a $100,000 gain, but you might actually have more because you've been depreciating it. Now, taxes right now, you'd probably pay anywhere between 15 and 20% because it's long-term capital gain.
Just
And so,
8 or
yeah, so
something.
you've got a $20,000-$30,000 tax
Yeah.
in order to sell this property. But if you are immediately going to sell something else or buy something else because you love being a landlord, you like these investment properties, well, you just use 1031 and you can roll the profits right into the new purchase. That's what 1031 is, right, Dad?
That's exactly what it flows out of a case called the Starker case in the early 80s, where some
Right.
escrow money for 10 years in a separate fund for the purchase of a new house. IRS wasn't happy about it. They filed suit. And in tax court, the court ruled that the buyer could, or the seller could defer the gain to the new property. So they weren't real thrilled with that. So they passed
Yeah.
this code section limiting it in time to the time that you just mentioned, rather than the 10 years that the case allowed.
Yeah.
And it says business property, trade of business property, investment property. So any of those qualify. And for those who don't know, I worked for a tax firm when I first got out of school for probably 10 years in Miami.
Yeah, so I think it's a really cool tax code, but there's some really big tricks with
Yeah.
it. Um, what are some of the tricks, Dad? Just off the top of your head, what are some of the things that people have to consider? The first one, obviously, is you sell a property, you buy a replacement. So it has to be like kind. What does like kind mean?
It's pretty much anything. It could be a 99-year lease. It could be vacant land. It could be an office building. It could be a home, any form of real estate whatsoever, except
Give me
for
some examples. So if you had a say you had your office, Dad, you owned an office and you sold it, you could have bought a rental
vacant
property,
lot.
right?
I could have bought a vacant lot. I could have bought
Vacant lot,
a gas
any sort of
station.
investment property.
Raw land. I could have bought another house. I could have bought a condo. It could be a
Yep.
commercial condo, a residential condo. I could have bought something on the Cape, which would have made your mother really happy. And,
Yeah,
and
so it's not limited to geographical
has to be in the United
restrictions.
States, a
Anywhere
geographically
in the
state.
US, you could buy something.
Yeah.
And so how much time do you have to do this?
You have 45 days to identify a replacement property. Now, they have a rule, we call it the three properties rule. You can identify three properties regardless of what they're worth. And if you try to get cute and identify every single piece of real estate in Collier County, they have a thing where it can't be
I don't
twice,
like that.
the 200% rule. It can't be twice the value of what you're selling. So it limits people like me from identifying, 108 properties. But
Well, yeah, they limit you to three that you have to. So 45 days, you identify. Now,
identify in 6 months to close up to the close of the tax year.
you're identifying that to who?
A qualified intermediary. It has to be
Perfect.
somebody who's holding the money, has a written agreement with the seller. It can't be somebody who's a disqualified person. They're a lawyer that's done 4,000 deals for me. They can't use somebody like that. I used to function as a qualified intermediary, but it got to be too difficult in keeping track of who I did work for in the last couple of years. So, we farmed that part out.
Yeah, so you've got 45 days to identify the property that you want
Right,
to buy.
right.
How many days do you have to actually close?
It's the lesser of the end of the tax year or 6 months. And
Yeah, I
again,
think it's 180 days, right?
180 days. And again, you think of the Starker case, which was 10 years. The IRS didn't give us 1031 because they like us. They did it because they lost a case, a big case that, it allowed people to defer income for up to 10 years, for crying out loud. So they
Right,
came in with this just to limit their exposure.
right. So can you buy, what would happen if you bought, so in my example, we had the
Hmm.
$300,000 rental property.
Hmm.
We're selling it for 300,000. We would have had maybe 100,000 in gain. What if I buy something that's only 200,000? What then?
Well, you've depreciated it. You have to look at both depreciation and also capital improvements. You might have put a new roof on it. You might have put in new air conditioning. So things that would drive, that gets added to the basis, and the
Right.
depreciation gets subtracted from the basis. Really where I start, Christian, and I've done this a lot, I tell my seller, don't let the tax tail wag the dog. Okay, don't buy something just to save taxes. You might end up with a piece of garbage, something that's hard to sell. If you're going to buy something anyways, and you love the thing anyways, you're crazy not to do the 1031.
Yeah, yeah. But you can buy something that's cheaper than what you sold. You just don't get all of the benefit,
You
right?
pay tax on part of it. So,
Yeah, so in this hypothetical, you're selling a $300,000 house and you end up saying, all right, I want to buy this
yeah,
$200,000 house. You'd get two-thirds tax benefit where you wouldn't pay two-thirds of your capital gains
you're
taxes.
spreading your gain out. You pay some now and some when you sell it later, or if you don't sell it later and you
Right,
pass
right.
away, you get the step up in basis and you don't pay it at all.
And then can you buy more than 300,000? So you sold 300,000, can I buy
Yeah.
a $400,000 property?
My classic example, Christian, is let's say it's a $900,000 property. I'll tell my client, if you find something for 800 that really turns you on, and you think it's really worth 950, you know, buy it for 800, pay the tax on 100,
Right,
which is like
right,
23,000. You,
right.
you've made it back because it's worth 50,000 more. Plus you like it.
Plus you like it and you paid a
Plus you
little bit of
like
the
it.
tax now, so
Yeah.
you don't have as big of a tax burden.
So you look at the lower price stuff, you look at the higher price stuff. What if you find something and using 900 is what you're selling, and you find something for 1.1, but it's really worth 1.4?
Right.
Oh, hell, pay the extra.
Pay
Pay.
the extra. Pay the extra. It might actually allow you to kind of jump into stuff.
Yeah,
I think a lot of people when they're buying, real estate, they're looking at potentially two things. One
yeah,
would be the rental income, some sort of, income while they
yeah.
own it. And the other would be a price appreciation. And
Appreciation.
it's almost impossible to predict what the price appreciation will be
Yeah,
unless you're looking at value add opportunities. So if you buy something for the 200 and you put on a new roof or you add a little bathroom and now it's
right.
all automatically is worth 250 or 300, that's value add. And now you want to do that at the next house. But you
Well,
don't want to pay all those taxes now. So you roll it into something bigger or maybe smaller, or you could split it into two properties, right, Dad?
you can split it. I see Christina's question. Again, you're identifying three. If you're going to go over three, you got to worry about what we call the 200% rule. You're selling something for 1 million and you're going to identify five, say. The five altogether can't be more than 2 million. Okay, that's the 200% rule in action. But again, you don't let the tax tail wag the dog. You don't try to. What I saw happen all the time, they tried to make it perfectly match. They're going out of their way,
Yeah.
not pay 5 cents worth of taxes,
Right,
even if
right.
that meant buying something that wasn't as good as some other property they like. That might be a little
Yeah, it
less
didn't have
or a little
value
more.
add opportunities. Yeah,
Yeah, they're letting taxes drive the ship.
yeah, exactly,
The
exactly.
deal should drive the ship.
Now there's an IRS publication, let's see if I can remember the name correctly, FS 2008-18. Again, I'm going to write an article that goes out this weekend that talks
Right.
about this so you can share it with customers or you can learn for yourself. But this publication also talks about flips. This doesn't work well with quick turnaround of a sale. So let's say you buy something with the intention to flip it immediately. You buy it for two, you know
Right.
it's worth three, you turn it like within 30 days, you try and sell it or less. There's case law in this publication that directs to that saying that's not what this is for.
It has
That
to be held for investment. And the question is, what does hold mean? Is it 5 seconds or is it
right.
2 months? There's a safe harbor of 2 years.
Two
If you hold
years.
2 years, you can turn it into personal use property, make it your second home, make it your primary, and then live there the next 5 years and
Right.
sell it and exclude half
So
the
yeah, yeah. So safe harbor rules, Dad. Explain what a safe harbor rule is.
It's a provision in the regulations. We got the regulations in the office that says they're not going to argue with us on whether it was held for an appropriate period of time.
Yeah, you
If you
basically
hold
there's
it
no audit
2 years,
risk, right?
right? The
Yeah.
IRS is pre-agreeing that 2 years is long enough.
2 years is long enough. And so for someone who is totally risk averse, 2 years is a very safe way to say, hey, well, if
Right.
you own it for 2 years, you can flip it into something else, 1031. There's a lot of case law that says it doesn't necessarily
It
have to
doesn't
be
have to be
2 years.
that. What I would tell my sellers would be, don't have it relisted for resale like the second you're buying it.
Right,
You know,
right,
that shows your intention. If you
right.
have a whole bunch of emails from your realtor saying this is great investment property, and you have emails back saying, yeah, we're going to be using this as our winter home for the next 50 years, that's all evidence that they would look at in an audit.
Yeah.
I did the exchange with my dad. I don't know if you knew that, and we violated all this. And I played the audit lottery. What are the odds? Am I going to get audited personally? Um,
Yeah, so ultimately we give the client the information. The
yeah,
safest thing to do is 2 years. You might be taking a small gamble if you did it less than that, but the whole point is investment property for investment property.
yeah.
That's
I tell
you,
them to
you
paper the file with a lot of things from the realtor
yeah,
saying,
yeah,
this is a good investment, hold it for a long time, and emails
yeah.
back where you're going to hold it.
Exactly. I don't know if that board was very helpful because I don't think anyone could actually read it. But let me see. We talked about what is a like kind.
How about
Um,
reverses? That comes up a lot.
yeah, we'll get to reverses. So individuals, C corps, S corps, partnerships, LLCs, trusts, they can all do these 1031
Right,
exchanges. We talked about the timelines, 45 days to identify property,
right.
180 days to close on the property. Exchange types you have, and this is what you want to talk about, Dad, simultaneous exchange. So you sell and buy essentially on the same day. That's okay. Question for you, Dad. Do you still need a qualified intermediary?
Yeah.
You do. So a
And
lot of people, and this comes up quite frequently, a lot of people think, well, if I never touch the money, I don't need to do anything else. And that's not true. You
not
still
true.
need that qualified intermediary who can basically shelter you from the sale proceeds and roll them right into the
If it's
purchase.
sitting in your attorney's trust account, you think you're not touching it. You have the right to demand the money.
Right. It's
Uh,
your money.
you
You
have
could just not
constructive
close.
receipt, is what they call it. You have constructive receipt of the money, even though it's sitting in Christian's account.
Right. And so far, we've talked about, so that was the simultaneous exchange. We've talked a lot about what they call a deferred exchange. So a deferred exchange is you acquire the replacement property before selling that's the reverse. Sell the relinquished property first. So this is the most common. You sell your property first, and then within the 180 days, you buy the replacement. But then reverse exchange, Dad. Tell me about reverse exchanges.
Reverse is when you find your replacement, you're listing a property for sale, it hasn't closed yet, and you found the property you want to replace it with, and you're going to close on that first.
Yeah. Right.
The egg is going to come before the chicken in this case. And in that case, typically they set up an LLC, the qualified intermediary does, and you fund the LLC so it has sufficient capital to buy the replacement property. It's a
Yeah.
loan. And when you sell your other property, the LLC can repay the loan.
Yeah, so a couple of things on a reverse exchange. Number one, people really like this because it avoids what's called the 1031 squeeze. You're squeezed because you have only 180 days to buy, right? That's the typical
Yes,
squeeze. This takes that pressure off, at least in part, because you've already bought the one you like. You had to pay it. Dad, you mentioned it being a loan. Let's say I'm doing the exchanges. I'm the buyer and the seller.
right.
I'm using my money. I'm lending money to this
To
LLC.
this
The
LLC,
LLC is buying it on my behalf
correct.
through the qualified intermediary. So I have to pay for this property before I sell the other one,
Right.
and that's how it works. But it takes
That's right.
that squeeze away because you don't have to worry about closing within the 180 days. But it creates a different kind of squeeze because now you have 180 days to sell. Is that
Yeah,
right?
that's correct.
So you still have somewhat of a squeeze, but maybe you're in a little bit more
You're willing
control.
to take that gamble that it won't close.
Yeah, I would say most of my clients that utilize this, they already know or they're already under contract. So I did a closing about a month ago where they knew what they were buying and their investment property that they owned in a different state, that was closing like 30 days later.
Yeah,
So they were both under contract and they just they had to, do this reverse to kind of cover that difference. It's
The
a little
problem
more
you run into
expensive.
there is a lot of closings up north they don't have times of the essence. So they
Right,
think it's going to
exactly.
close on such and such a date, and you got to warn them, talk to your lawyer because in that particular state,
Right,
it's of
exactly.
the essence.
Now, a couple of other tips and pointers. Personal property is not like kind. So if you're buying $100,000 in furniture, that's not going to be allowable for a qualified exchange. So be very careful what is included in a sale and how things are itemized in that way. Um, it could also be like an accounts receivable if you're buying a business or something like that. That could be problematic. So
New
basically,
construction can be a problem.
yeah,
If
there
not,
are new construction 1031s where you fund it over a period of time. I would say I've done like one or two in my career. You've probably done a lot more than me, Dad, but
yeah.
they're difficult to execute. Very
The
difficult.
big danger with those things, other than the risk of not having all the liens eliminated, is that the portion of the home that's not complete is not considered like kind. It's considered a chosen action. So only the portion of the house that's completed in the land is like kind. So I tended to avoid those with a passion.
Yeah, yeah.
Plus the
So Christina had a couple of questions I want to make sure we hit. She talked about your examples, Dad. An office, like a commercial property,
mm,
is like kind to a house up in Massachusetts.
right.
Yes, it
Yes.
is. The distinction that you'd have to make is that as much as my mom would love to have a house on the Cape, when it's a 1031 exchange, you can't really use it personally more than 2 weeks. It's like a 14-day
You're
limitation.
not supposed to. It's supposed to be
We're
primarily
not, we're going to
investment.
give the right advice, right? If you guys want to break the law, we'll do that later, right?
Yeah, show some rental income, damn it, for the next 2 years.
Yeah. So Kim mentions also it can't be homestead. So you're right, Kim. I
Right.
mean, even if you tried to make it homestead, you probably don't apply. You would be violating the homestead rules more so than you would be openly violating the
Yeah.
1031.
You don't want to
So because
lie.
homestead says that you are not renting it out, that it is your primary residence, but there's no real time requirement for
Yeah.
homestead. But then 1031 says you are renting it out. It is an investment and you can't actually use it for more than 2 weeks. So I think, yeah, you just can't do both.
That
You
kind
got to
of
pick.
falls in the hogs get slaughtered category. You're asking for too much.
Yeah, you're getting greedy. So at that
Yeah.
point, you're saving a lot of money on the sale, not paying income taxes. But you're getting greedy by trying to get your property taxes to go down as well.
I mean,
Now,
having a working knowledge of this.
to wrap all that up, we
Yeah.
skipped over a pretty important part, and that's taxes. So if we don't worry about the deferred exchanges and we don't worry about 1031s, you have to still know what your taxes would be on a sale. So again, we're only going to talk about investment properties here. So investment properties are taxed just like stocks and bonds. You have short-term capital gains and losses and
Long
long-term
term.
capital gains and losses. So long-term capital gains, that's going to be based, it's 1 year or more.
Right.
That's based on your ordinary income tax rate, right, Dad?
Yeah. It's basically the maximum would be like 23.6 because they had that Obama tax on the
Oh yeah,
top.
I'm sorry. I wasn't saying it correctly. So long-term capital gains, year or more, I think it's 0, 15, 20, and you think might be 23, but it's long-term capital gains is a better rate. It's much smaller.
It's much smaller rather than being your ordinary income bracket, which you take your salary. That's the rate.
Yeah,
Yeah,
exactly.
right.
So that's long-term capital gains. That's what we want ideally if we're not
Mm,
using 1031 or anything else. We want a long-term capital gain because then it's going to be the lowest rate possible when you do sell. So on a $100,000 gain, you might pay $20,000 in taxes. But short-term capital gains, that's less than a year. So
it's
if you
ordinary
own this
income.
property, you sold it on one of those quick flips, and you
Yep.
made a $100,000 short-term capital gain. Yes, you have a bigger return on investment potentially
Right.
because your turnaround time was less, but your tax rate matches your ordinary income rate.
Yeah. It's
That
like
could
a
be really
bonus at work.
problematic. Yeah, let's say you had a 30% tax rate. and you made 100 grand on this, you'd be paying 30,000 in taxes instead of a 20% tax rate if you
Right,
held it for at least a year. And so
right.
that difference, that $10,000 difference might be worth it just to wait to sell, especially as the numbers get bigger and bigger, and especially if your tax rate is in the really high numbers. So, you mentioned, Dad, don't let the tax dog wag the tail.
Tail wag the dog.
Right, right. What you mean by that is make your best investment, buy the right property, and then see if you can use the tax code to supercharge your returns or at least limit the damage. And that's
Might
what
pick
this
up
is all
another
about.
deal. I mean, if you're a listing agent and your client sold something, I mean, asking about their future plans could get you another transaction.
Yeah, exactly. If you guide your client who's selling an investment property, some rental they've had for a long time,
Right.
you might be able to give them this information, connect all the dots, and maybe they come back to you saying, my accountant says that I should find a replacement. Let's start looking.
Yep.
So that could be pretty
Did a
incredible.
lot of that.
There's a lot of that. And so obviously it's not ideal for someone that is sick of having investment properties or really needs the money. It might be someone, maybe you can convince them to buy an empty lot, and so
I
much
would
lower
get people in
maintenance.
their 50s, Christian, who are 10 years from now, they're going to retire so they can buy that vacant lot in exchange, hold it for the 2 years,
Yeah.
and then convert it to personal use. And by the time they build a house, they're ready to retire.
Yeah, exactly. All right. Well, I think I've bored you guys long enough. Dad, I appreciate you letting me pick your brain.
No
I think
problem.
this stuff I think it's a lot of fun, but again, it's not a priority for your clients. It's kind of like a secondary consideration, something that can
Yeah, you might pick
maybe
up another
juice
deal is the way
returns.
I look at it.
Yeah. All right, guys. Well, I wish you luck. If you need us, just call. Looking forward to hosting you again next week. Actually, I'm not doing this next week. I'll be out of town, but if you need us, just call us. Bye, guys.
Hi, Chris.